if we have a drawdown in the market, it's going to take Bitcoin down with it. Bitcoin's not going to take the market down. Bitcoin will get dragged down by the market because of the need for liquidity. Because when you get into one of these events and you're an investment manager, you walk onto that floor, and I've said this many times before, you don't decide which assets you're going to pick and choose. Well, maybe this one's up a little bit, and we're going to sell some of this. And maybe you walk in, you're just like, I want to sell 10 or 20% of everything. Just get me out. I don't care. I need cash so I don't get a margin call.
Not long ago, Lavish himself declared the 4-year cycle dead. His reasoning was logical. Bitcoin seemed increasingly tied to global liquidity conditions rather than its halving schedule. In a world dominated by central banks, interest rates, and macroeconomic forces, it made sense to assume that liquidity, not scarcity, would drive price action. But he now admits he was wrong. The 4-year cycle didn't disappear. Instead, it evolved into something even more powerful, a self-fulfilling prophecy. As Bitcoin surged past $100,000, a psychological shift occurred. Early adopters, often referred to as OGs, began selling significant portions of their holdings. These weren't small traders. These were individuals sitting on tens of thousands of Bitcoin, accumulated over years of conviction and risk-taking. Their selling wasn't irrational, it was logical. They were monetizing life-changing wealth. Buying land, securing generational stability, achieving financial sovereignty. In many ways, this behavior reinforced the very cycle many thought had vanished. As prices peaked and large holders distributed supply, the market naturally entered a downturn phase, just as it had in previous cycles. The difference? This time, the players on the other side of those trades were not primarily retail investors.
First of all, the 4-year cycle. I thought the 4-year cycle was dead. I declared it dead last year. I said, I think it's on a liquidity cycle. I don't think that it matters. The halving does not matter as much anymore. It just is not, it's kind of dead. I was wrong. And the reason I was wrong is because it is a self-fulfilling prophecy. The 4-year cycle started dying. The price of Bitcoin started turning over in the 4-year cycle, and the 4-year cycle started solidifying when we got up over $100,000, and all the not all OGs, a number of OGs that were sitting on tens of thousands of coins were just selling relentlessly from $100,000 to $125,000 and monetizing all of that wealth that they had accumulated over the years through the price of Bitcoin. Again, I want to be clear. I don't blame them. They took risk for over a decade. Some of these guys and gals, that they're sitting on all this Bitcoin, and they're like, I'm going to go monetize this, and I'm going to secure my legacy. I can go buy land. I could go buy an estate. If I want to buy an airplane or a boat, whatever, that's fine. But whatever you want to do, but they can become completely self-sovereign. Buy a huge ranch in Texas or Montana or Wyoming or wherever, and just say, I'm out. I'm going to go to Costa Rica. I'm going to go to wherever I want to go, New Zealand, play with the billion or the trillionaires, And so that started that solidifying the 4-year cycle mentally. And so, but the difference here is, Kyle, is now we've got, over the last number of months, we've got more institutions buying than retail. Retail has been the ones who've been selling from 100 all the way down to here. And so, by and large. And so that's the interesting development. Why is that important? It's important because I think that it holds down the volatility of this cycle, meaning we're used to 70, 80, almost 90% drawdowns from one cycle to another. Mm-hmm. Well, this cycle we had a 50 some odd percent drawdown, and we went from 120, it got all the way up to 126,000, and then the drawdown went all the way down to 60. So more than 50% drawdown. And we've stabilized. We've stabilized in here because there's been more institutional buying than there has been retail buying. Very interesting. And the ETFs have been, there's a lot of money that's been flowing into the ETFs recently. Do I think we've bottomed? I think that if we do not have an event like I described, the credit event, a flare up in this conflict out in the Middle East, or some other black swan that we don't see, and we don't have a correlation to one event in the whole market, I think Bitcoin's touched bottom. Now, I'm not saying that I'm to be clear, if we have a drawdown in the market, it's going to take Bitcoin down with it. Bitcoin's not going to take the market down. Bitcoin will get dragged down by the market because of the need for liquidity. Because when you get into one of these events and you're an investment manager, you walk onto that floor, and I've said this many times before, you don't decide which assets you're going to pick and choose. Well, maybe this one's up a little bit, and we're going to sell some of this. And maybe you walk in, you're just like, I want to sell 10 or 20% of everything. Just get me out. I don't care. I need cash so I don't get a margin call.
Mm-hmm.
So, and that happened so rapidly in correlation to one events. It happened in 2020, where what happens is the prime broker, it's not like Reg T where you get this 50% margin on your assets, like on the New York Stock Exchange. These prime brokers, they have agreements with their hedge funds that give them more leverage, and they call them haircuts. And these haircuts can be anywhere from, 90 or 100% for really illiquid small caps or micro cap companies, down to just 5 or 6% for your Mag 7 blue chip technology companies in the S&P. Meaning you could borrow 95% of capital against it. Well, in a correlation to one event, you walk into the floor that morning and they say your haircut went from 5% to 25%. Boom. You got to come up with 20% more capital in every single one of those positions, which are likely your largest positions. And so, again, you don't have a choice. You got to come up with that capital. If you're not sitting on treasuries or cash, you're in trouble. You got to go raise capital. And so that's why these guys do that. That's why you see Bitcoin move on these weekends. It's managers getting ahead of something and say, I've got to get out of this on Sunday and maybe take some money off the table. Why Bitcoin? Because the only thing is trading, Yeah. The markets aren't liquid enough in the after hours markets for some of their other assets. Bitcoin's liquid enough. So that's a long way of saying, Kyle, is I think that yes, we have touched bottom unless we see a big event. That's my sense. If we do have a big event, where does Bitcoin go? If it gets into the high 40s, I would think it would be a screaming buy.
Yeah.
But that's me. I run a Bitcoin opportunity fund with David Foley, and we're waiting for that. We're actually hopeful. We've got some some hedges on that we would be able to monetize and plow into Bitcoin adjacent companies that would be, I think, quite profitable. I don't care how long it takes. This is going to be an extraordinarily profitable area of investment for in the near future.
Lavish suggests that Bitcoin may have already reached its bottom, assuming no major external shock occurs, but he's careful to add an important caveat. Bitcoin does not exist in isolation. In the event of a major market-wide crisis, a credit event, geopolitical escalation, or financial system shock, Bitcoin will not act as a safe haven in the short term. Instead, it will likely be dragged down alongside other assets. Why? Because in times of crisis, liquidity becomes king. Institutional investors don't carefully choose what to sell. They sell everything. When margin calls hit and leverage unwinds, portfolios are liquidated indiscriminately. Bitcoin, being one of the most liquid assets trading 24/7, often becomes a primary source of emergency liquidity. This is why Bitcoin sometimes drops sharply during weekends or outside traditional market hours. It's one of the few assets that can be sold instantly. However, Lavish sees these potential downturns differently than most. If Bitcoin were to drop into the $40,000 range due to a macro shock, he views that not as a failure, but as a massive buying opportunity.
Yeah. And, okay, I have not seen the CoffeeZilla video. I've heard, some noise about it, but by and large, I ignore nonsense. But if he had something that I felt was really important, I would look at it. But here's the reality. So number one, first, full disclosure, I sit on the board of directors of Strive, which is ASST, and we have a similar preferred instrument called SATA. Now, ours is a fraction of the size. It's $437 million worth right now. But we're doing the same thing where we're issuing the preferred, basically preferred note in order to turn around and buy Bitcoin with that and put it in the balance sheet. It's been an extremely positive development for ASST. And, even just as a shareholder in my hedge fund, I'm extremely confident and I have high conviction in that company, in their management, in Matt Cole and the rest of the team. They know what they're doing, and I'm happy to sit on that board and be part of this. That's number one. Number two, the bigger picture with MicroStrategy, with strategy, and what Michael Saylor and Fong Li are doing. Well, and Sharish, I should say, their treasurer, who's been instrumental in coming up with these preferreds and the different instruments and way to accumulate capital. So what are they doing? Well, they're issuing this preferred, and that's right. It's a perpetual preferred. That's why it's called a perpetual preferred. It doesn't have to be paid back ever. But if you want your money, you can go into the market and get it back. If you buy $100 worth and you want to get your $100 back, it trades on the New York Stock Exchange. It's not like this convertible bond that you got to find a market maker to get liquidity in. This is something that trades right there on the exchange. So that's number one. Number two, first of all, the amount of stretch, STRC, the one he's talking about that's out there, it's now at about $6.4 billion. Okay, so $6.4 billion. That's a lot, right? But Michael Saylor and Strategy have $58 billion of Bitcoin on their balance sheet.
It's crazy.
Every single time they go out and issue stretch, they turn around and take the vast majority of that and buy Bitcoin with it. Now, I don't know exactly how they're managing their cash from when stretch does go above par. It means that they can sell it into the market. They can basically issue more and more preferreds at a better yield than the 11.5% that they have on it right now. I mean, it's a no-brainer. Of course you would do that. And then you turn around and take that money and you buy Bitcoin. You take some of it and you put aside for dividend payments. But they've got $2.2 billion sitting in reserves for paying those dividends right now. The reality is, if they're issuing stretch, this preferred, turning around and buying Bitcoin and putting it on their balance sheet, and that Bitcoin then it's covering all of their debt, right? So that's number one. Number two, they are issuing some shares. They're issuing, they're tapping what's called the ATM at the market, where they are issuing common shares to also raise a little money to either be buying Bitcoin or to be putting into cash reserve to pay these balances. Mm-hmm. But that's okay, because they're issuing so much stretch that they're buying more Bitcoin, and you're still getting more Bitcoin per share from day to day. And that's just been going up. The Bitcoin per share is going up. So the real question is, are you in danger as a shareholder? Are they going to issue all this preferred, turn around and buy jets and planes and sports teams and whatever they want to do, or actually that would probably be a good investment, just buying assets that are completely depreciating or just blowing the money on whatever, and then not adding it to the reserves, and then suddenly whatever is left on their balance sheet is up for grabs for the preferred someday. Yeah, that would be a problem, but he's not doing that. He's buying Bitcoin with it. So if you believe that Bitcoin's going to zero, this is not an investment for you. This is not your instrument. But if you believe in Bitcoin as a long-term asset, this is a no-brainer for you. Because if you're sitting on cash that's making 3.8 or percent in a money market right now, and you could turn around instead get 11.5%, but you don't need that capital. Again, be aware, this could be volatile. It could be up or down 10% because of the nature of it being a preferred, it paying the dividends monthly. It draws down in periods right after it pays a dividend and that record date is off. That it produces a little bit of volatility. You could see it moving around. I haven't looked at it today, but I can see it's at $99. They just paid their dividend. So it's not that as volatile as people are making it out to be, number one. You saw that it's got the using your typical measure for volatility on Wall Street. It's got the best Sharpe ratio out there of any security out there. That's just astounding. Now, the volatility might better be attached if you're going to use that measure to the volatility of the yield, but the yield has been pretty stable. It's at 11.5% right now. Last I remember, I don't own any stretch myself, but yeah, it's 11.5%. But look, if you don't need capital and you're going to be sitting on it for years at a time anyways, and you believe in Bitcoin, it makes sense for you. If you believe in Bitcoin and you want more exposure to the upside of Bitcoin, then the shares of MicroStrategy make sense to you. It is the largest holding in my hedge fund, and it's the largest holding for a reason. We've been long-term holders of this thing. We started doing this years ago. We started buying strategy years ago, and we believe in Bitcoin long-term. And we believe in the strategy that Michael Saylor is employing and his team. And we believe that this product Stretch is a way for them to just continue to expand the Bitcoin per share. Not ad infinitum, right? Ad infinitum, but this could be hundreds of billions of dollars. And the amount of money that's out there chasing yield right now, you're talking about markets and investors and institutions that are reaching for yield everywhere. And where do they reach for yield? High yield investments, which are higher risk. Sometimes investments that are near distressed, that are much higher risk. And then, of course, in private credit situations where, you're giving money to a money manager and hoping for the best, and you're only getting a few percent more than you would get in a high grade corporate bond. So it doesn't really make that much sense when you look at that versus something like this, where you've got full liquidity. It trades a massive amount every single day. And it pays you a much better yield. That's where this is going to start siphoning money out of those markets, out of the areas that institutions have been reaching for yield in high yield and private credit and those areas. So when you say, how big can this be? How big can it get? I mean, it could be gargantuan. And the amount they have on right now, the $6.4 trillion is just the beginning, in my opinion.
One of the biggest macro themes today is the global search for yield. Traditional safe investments like government bonds or money market funds offer relatively low returns. As a result, institutions have been pushing into riskier areas like high-yield debt and private credit. But these markets come with trade-offs: lower liquidity, higher risk, limited transparency. In contrast, instruments tied to Bitcoin, like those issued by MicroStrategy, offer higher yields, daily liquidity, direct exposure to a high-growth asset. This combination is incredibly compelling. Lavish believes that over time, capital will begin to shift away from traditional high-yield markets and into Bitcoin-linked financial products. And if that happens, the scale could be enormous.